Hello everybody and welcome to the Cyclical Investors Club YouTube channel. In this video we're going to be taking a look at Bristol Meyers Squibb stock. I do own this one and this is going to be a pretty quick analysis basically because things are kind of just not really going anywhere for these guys. If you have a stock you'd like me to analyze, just drop it in the comments section. If it's in the S&P 500, I'll put out a free YouTube video on it eventually. And if it's not, I post those over on Patreon, and if you join there, you get a big discount from my full service, where we have all the spreadsheets and chat rooms and updates, and you can chat with me and pretty much anytime, and portfolios and all that kind of stuff. But for now, we're just going to take at Bristol Meyers Squibb. This is not individual investing advice. This is just how I analyze stocks, and I do own this one. Although I'm probably not going to be like recommending it, which usually people that own stocks rarely tell you not to buy the stocks that they own. But this is going to be one case where I am going to do that. I'll give you a little heads up. So drug stocks are tricky for the type of analysis that I do, which uses historical earnings trends basically to try to value the stock, because patents have patent cliffs, and you never know what they're going to. You can see those coming sometimes, but then they can litigate and they can change sometimes the formulas, and they can add different drugs, so they can do all kinds of stuff. So you never really know when the patents are going to be coming to an end and what the competition will look like after that. You also don't know what new drugs that they're going to come up with that will work, and also how big they will be. It's not uncommon for kind of a moderately successful drug to then go on to be even more successful when it's like combined with something else and so forth. So my view is we don't really know what's going to happen with drug stocks, and I'm probably not going to know more than like one of the experts would know that actually do this kind of stuff. And honestly, I don't think they know most of the time. But you still can try to buy them when they're pretty cheap. And then just especially if everything else is kind of expensive, which is the way it's been lately. And then just kind of wait and see if they can come up with something that's great in a few years. But you have to kind of be patient with these for sure. So the first thing I would note is, if you just look at the fast graph here, it looks really cheap. So 7 PE, right? And that's probably what would attract somebody to the stock. The dividend is also pretty decent at 4%. But they have had quite a bit of M&A, and I avoided them usually if a stock has big M&A, I just avoid them for 3 or 4 years, honestly, because they always think things are going to be better and the M&A is going to work out better than it does. And then by the time they write everything down, the stock price the earnings disappoint first, and then the stock price comes down. And that process usually takes a few years. So I waited a little while before I bought I forget when their M&A was. It might have been back here. But I bought these guys right at the end of 2020. Again, the market had bounced a lot off I think I bought it in December of 2020. And I'm basically flat on with this. So down like 2%. That looks about where I'm at right now with it, if you include the dividend. So I've been kind of waiting around, and nothing of significance has happened. But what I would point out to everyone is, when I value this stock now, I'm not using the adjusted earnings. Because they've had M&A, because they have a lot of other stuff going on, I use the basic earnings, and that I think gives a little bit truer read to the valuation. So when you do that, there's a big difference. We only have $3.75. That's more of like a 14 or 15 PE, and that's like where you might expect like a stock to trade, right? So the first thing I would say is, this is what I'm using to currently value the stock price. Are these earnings and not the adjusted earnings. So that immediately makes it look average priced just on the surface, and that's actually about what I would say that it is if we go into my spreadsheet here. So I figure about 5% average earnings growth is what these guys have done for the past since 2015 or so. And when you use basic earnings of 375 with 5% earnings growth, that gives you earnings yield of about 7%. So the way I like to think about this is if I bought the whole business for $100, it would earn $7 a year that I could just keep if I was the owner. And that would grow at like 5% a year. And then what I want to know is how much that would grow over 10 years, which is about $93. It would almost double in 10 years. These guys do have, so that would normally be about a 7% CAGR, like a double in 10 years, just roughly. But these guys do have some debt. So let's take a look at that. So the difference between here and here is what I usually just quickly look at to kind of factor debt into the valuation anyway. And so when I figure that in as well, the valuation looks a little worse, and I get like a 6.82% expected 10-year CAGR from the earnings as like a business owner. This is right around what I would call like fair value. Like 6.5% would be just long-term generic fair value. If it got above 8%, which would mean the price would have to come down or earnings would have to go up, that would be more close to a buy. And then at 5%, it would be closer to a sell, all other things being equal. So the tricky part here is, so it looks like the market is just valuing this normal. Like when I just look at this, when I look at the basic earnings, when I think about the debt, when I think about they haven't really had like a whole lot of growth, but a little bit, like nothing's good or bad. It's just kind of bleh, like nothing, which is exactly what the stock has done for the past 3 years that I've owned it. At that point, it just kind of, everything kind of looks pretty straightforward and clear. Now, the one thing that I'm watching as an owner of the stock is this is the 3-year revenue growth. So we're getting into the period now where it's been a while since they had that big M&A, which will boost revenue growth because you're adding like a whole bunch more revenue to the business you already had. And that kind of distorts this a little bit. But now we're getting into the period where we can actually see what the combined business's revenue growth looks like. And it's only 6% over 3. This is a 3-year number. So this is basically like 2% a year, which is not attractive to me. You'll notice this has like a yellow coloration to it, and that means that that's kind of not good. Like I wouldn't, unless something else is going on, it's cyclical, blah, blah, blah. Unless there's another explanation. Like this, it would be, I would not buy a stock that had revenue growth this slow. I already owned it, so I haven't sold it. But I think if this turned negative, I would probably just go ahead and sell. Unless there was some catalyst that I saw that was pretty clear that was going to come along. So, and again, if you think about it, let's say in 6 months, this turns negative. Well, I owned the stock for like 3 years, 3.5 maybe at that point, and it's basically flat over that time. So I didn't really lose any money because I was waiting around for something good to happen, and basically nothing good happened, and it just went nowhere. And so, but it could go down. I mean, if revenues keep going down and like nothing good happens, the stock price will go down too, and that's what we've seen. So since the peak, like we were doing okay with it here, but you know, it's down like 30% off. That wasn't even the high. Down 35% off the high. So because we see things are just kind of slowly fading away. So if that were to continue another couple quarters, that would probably be enough for me to just sell the stock and call it, wasn't like a big loser, but not a winner. And then to move on to try to find some opportunities that are actually growing. So that's how I would think about it. I would call this a hold right now. Probably an avoid unless you see things pick up with revenue for a new investor, and maybe a sell coming up, just kind of depending on how things go. It doesn't really have too much to do with the stock price at this point. If that revenue went negative, even if I was up 20% in the stock or down 20% from where it is now, that kind of trumps everything for me. and I would just say, okay, this isn't, however it turned out, it's not headed in the direction that I want. That's a metric I really pay attention to. And in this case, I would go ahead and I would sell. So that's my very personalized take on Bristol Myers. And when applied to like an individual stock, I'm not telling anybody much about the business and specific pipeline that they have and all that. But it doesn't seem like it's a particularly great analysis. But when you apply it across the board, like I have Merck too, right? And they've actually done well because Keytruda, they keep finding new ways to use it. They got a little boost from COVID. And so that's one where the same principles were applied. It did work out, right? And this is one where it didn't, but I didn't really lose any money. I haven't really, not yet anyway. And then, but if you keep repeating that over and over again, usually you'll limit your downside and you'll capture more upside than normal, and it will work as a bigger process. So that's just how I do it. That's my thought. Probably the main takeaway for like the average investor is it's not as cheap as it looks when you look at the adjusted earnings. So to me, the basic earnings really tell the story of exactly what's happening with the stock. So that would be my biggest message, is to look at those, and that pretty much shows that it's not like super deep value or anything, in my opinion. It's just normally priced. All right, if you found this useful, click the subscribe button, and I'll see you guys in the next video.